Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah Chen, and joining me as always is Mike Torres. Today we're digging into Boeing's 10Q filing for the second quarter of 2026, filed on July 28th. This is a company that has been through an extraordinary period of turbulence, and this quarter's numbers tell a genuinely complex story. Mike, let's get into it.
Thanks, Sarah. Before we dive into the details, let me give listeners the one-sentence thesis for this filing, because I think it cuts through a lot of noise. If we reduce this filing to one sentence, it's this: Boeing is generating more revenue than at any point in recent memory. But the commercial airplane business is still bleeding cash. The defense segment just took a fresh loss, and the operating improvement this quarter is substantially a function of a charge that disappeared from the prior year's books rather than genuine margin recovery. Based on this filing, Boeing is operating in structural reset, not early recovery, not expansion, but a company still rebuilding the fundamental economics of its core business.
That's a sharp framing, and we're going to test that thesis hard over the next 15 minutes. Let's start with the material changes, because the headline numbers here are genuinely jarring.
They are. Revenue for the quarter came in at $46.78 billion. That is a 110.5% increase compared to the first quarter of 2026, which posted $22.22 billion. Now, before anyone thinks Boeing suddenly doubled its business, that comparison is heavily influenced by the Spirit AeroSystems acquisition closing in December 2025, which folded a major supplier's revenue base into Boeing's consolidated financials. So the year-over-year comparison against the same period in 2025 is the more meaningful lens, and the filing tells us revenues increased by $1.811 billion for the 3 months ended June 30th, 2026, compared to the same period in 2025. That's meaningful growth, but it's a far cry from the headline 110% number.
And operating income?
Operating income came in at $604 million, up 34.8% from $448 million in the prior quarter. But here's where the causality chain gets important. The filing is explicit about what drove that improvement. Management states that the increase in earnings from operations for the 3 months ended June 30th, 2026 was, and I'm quoting directly from the MD&A, primarily driven by a decrease in loss from operations on unallocated items, eliminations, and other, specifically $405 million of that improvement. And then the filing explains why. The prior year quarter included a $445 million earnings charge related to an agreement with the Department of Justice. That charge is gone this quarter. So strip out that one-time item from the prior period, and the underlying operational improvement is far more modest than the headline suggests.
So the operating income improvement is largely a base effect from a prior year penalty, not a structural margin recovery.
That is exactly right, and that is a critical distinction for anyone reading these numbers. The causality chain here is, if the DOJ charge absence is the primary driver of operating improvement, and if underlying segment margins are not expanding, then the investment case for a sustained earnings recovery remains unproven. We'll come back to that.
Let's talk about what management is actually saying in the MD&A, because the tone of this filing is worth examining closely.
The language is measured, and in some places, it carries real weight. On the supply chain, management states directly, and I'm quoting, "We and our suppliers are experiencing inflationary pressures, as well as supply chain disruptions as a result of global supply chain constraints and labor instability." They go further. Certain of our suppliers are also experiencing financial difficulties. That is not boilerplate language. That is management flagging that parts of their supply base are financially stressed. They also note that these factors have reduced overall productivity and adversely impacted our financial position, results of operations and cash flows. That's a direct admission of ongoing operational drag.
And on the production rate side?
Management is cautiously optimistic on the Boeing 737, The filing describes the production rate transitioning from 42 to 47 aircraft per month with FAA concurrence and a new production line that began low-rate production in July 2026. That is a concrete positive signal. But they immediately hedge it with a warning that backlog reductions and order cancellations could result from, quote, delivery delays, production disruptions, and delays to entry into service of the Boeing 777X, Boeing 737-7, and or Boeing 737-10. So in the same breath they announce a rate increase, they remind you of 3 programs that could derail it.
The Boeing 777X timeline is something I want to come back to in the segment discussion. But first, let's go to the financial red flags, because the balance sheet picture here is not clean.
Not clean at all. Let's start with net income, because this is where the story gets uncomfortable. Revenue is up, operating income is up, but net income came in at negative $448 million for the quarter. That compares to negative $4 million in the prior quarter, so net income deteriorated by roughly $444 million quarter over quarter. The filing attributes this primarily to higher non-operating pension expense, which reduced other income by $246 million for the 3-month period compared to the same period in 2025. Interest and debt expense did decrease by $110 million for the 3 months, which is a genuine positive from debt reduction. But the pension headwind is swamping that benefit.
And cash?
Cash and equivalents fell from $9.44 billion at the end of Q1 to $7.24 billion at the end of Q2, a decline of $2.2 billion, or 23.3%, in a single quarter. Now, the filing does note that operating cash flow for the 6-month period swung from negative $1.4 billion to positive $1.2 billion year over year, which is a genuine improvement. But the sequential cash decline in Q2 alone is significant. The causality chain here is direct. If cash continues to decline at this pace, while long-term debt sits at $45.6 billion, Boeing's financial flexibility narrows materially. That long-term debt figure, $45.6 billion, is the number that defines the constraint on everything else this company does.
And total debt actually increased this quarter?
It did. Total debt increased 59.9%, from $2.85 billion to $4.57 billion on a short-term basis, while long-term debt remains at $45.6 billion. The filing does note that interest and debt expense decreased year over year due to lower debt balances, which tells us Boeing has been paying down some obligations. But the overall debt load is still enormous relative to the operating income this business is currently generating. At $604 million of quarterly operating income against $45.6 billion of long-term debt, you're looking at a leverage ratio that leaves almost no room for another operational stumble.
Let's move to risk disclosures, because there are a few items in this filing that deserve specific attention.
The filing notes no new or significantly escalated risk factors compared to the prior quarter, which is worth acknowledging. But the existing risks carry real weight. The US-China trade relationship is flagged explicitly. Management states, and I'm quoting, "China is a significant market for commercial aircraft, and we have long-standing relationships with our Chinese customers." Overall, the US-China trade relationship remains challenged due to tariffs, sanctions, and export restrictions, as well as other economic and national security concerns. That is, a market Boeing cannot afford to lose, and the filing is honest that the situation remains unresolved.
What about the labor situation?
This is one I'd flag as a near-term watch item. The filing discloses that Boeing has 2 contracts with the Society of Professional Engineering Employees in aerospace, expiring October 6, 2026. That is less than 3 months from the filing date. Management states they are currently in negotiations, working toward reaching new agreements in the 3rd quarter of 2026. The filing is explicit that work stoppages have in the past and could in the future disrupt and or delay the production, delivery, and or development of our products and services. Given that Boeing is in the middle of ramping the Boeing 737 to 47 per month, a labor disruption at this specific moment would be particularly damaging. This is a concrete, time-stamped risk with a hard deadline.
And on U.S. government funding?
The filing notes that government departments and agencies, including what the filing refers to as the Department of War, NASA, and the Department of Transportation, are funded only through September 30th, 2026. Management acknowledges, quote, considerable uncertainty exists regarding how future U.S. government budget and program decisions will unfold. For a company where defense revenue is a critical stabilizer, that funding cliff is a real overhang.
Let's go deeper on the balance sheet and liquidity picture before we get to segments.
From a capital structure standpoint, the numbers tell a story of a company that is managing a very tight rope. Cash at $7.24 billion against long-term debt of $45.6 billion gives you a net debt position of roughly $38 billion. For context, Boeing's operating income for the first half of 2026 was roughly $1.05 billion, $604 million in the second quarter, on top of $448 million in the first. And even that includes the benefit of the DOJ charge absence. At that run rate, the company is generating a little over $2 billion in operating income annually against a $45.6 billion long-term debt load, more than 20 times that figure. That is not a healthy coverage ratio by any historical standard for an industrial manufacturer.
The operating cash flow improvement is real, though.
It is, and I don't want to dismiss it. The swing from negative $1.4 billion to positive $1.2 billion in operating cash flow for the 6-month period is a genuine directional improvement. The filing attributes it to favorable working capital changes. But working capital improvements are often timing related. They pull cash forward from future periods. The more durable question is whether delivery rate increases translate into sustained free cash flow generation. And that brings us directly to the segment analysis.
Let's get into the segments, because this is where the structural story really lives.
Starting with commercial airplanes, which is the heart of the Boeing thesis. BCA revenues increased $877 million for the 3 months ended June 30th, 2026, compared to the same period in 2025, driven by higher Boeing 737 deliveries. But BCA is still losing money. A loss from operations of $322 million for the quarter, improved from a loss of $557 million in the same period last year. For the full 6 months, BCA lost $885 million, compared to $1.094 billion in the first half of 2025. So the trajectory is improving, but this is a business that has now been in a loss position for an extended period. The backlog is genuinely impressive, $596.7 billion at June 30th, up from $567.3 billion at year-end 2025. At current delivery rates, that backlog represents years of production. But a backlog only converts to cash when airplanes are delivered, and BCA is still not delivering at a rate that covers its costs.
And the Boeing 777X situation is a significant drag on that math.
It is. The Boeing 777-9 first delivery is targeted for 2027. The Boeing 777-8 freighter is approximately 2 years after that. The Boeing 777-8 passenger variant is not before 2030. These are multi-year timelines on a program that has already absorbed reach-forward losses. The filing warns explicitly that additional reach-forward losses on Boeing 777X are possible depending on certification, supply chain, and customer factors. Meanwhile, the Boeing 767 commercial program is expected to complete production by 2027, which removes another revenue stream.
What about defense?
BDS is the segment that is supposed to be the stabilizer, and this quarter, it showed cracks. BDS revenues increased $2.2 billion for the 6-month period, which sounds strong. But operating earnings at BDS declined $47 million for the 6 months, and the filing is direct about why. A $280 million reach-forward loss on the VC 25 billion program. That is the Air Force One replacement program. Fixed price defense contracts continue to be a source of earnings erosion at BDS, and this quarter's VC 25 billion charge is the latest example. The defense segment is not subsidizing commercial losses. It is generating its own losses on fixed price programs.
And global services?
BGS revenues increased $370 million for the 6 months, but operating earnings declined $53 million, impacted by the Digital Aviation Solutions divestiture and an ERP system disruption. So all three segments showed some form of margin pressure this quarter. The filing notes that cost of sales as a percentage of revenues increased due to, quote, lower margins at BGS and BDS. That is a company-wide margin compression signal, not an isolated issue.
Let's close with what traders and investors should be watching. And let's revisit that core thesis.
The most time-sensitive item is the labor contract expiration on October 6, 2026. If Boeing cannot reach agreements with the Society of Professional Engineering Employees in Aerospace before that date, the Boeing 737 rate ramp to 47 per month is at risk. That is the single most important near-term catalyst to watch. Second, watch the Boeing 737-7 and Boeing 737-10 certification timeline. Management expects both in 2026 and the filing notes approximately 40 aircraft in inventory pending certification. Those deliveries represent real cash that is sitting on the ground.
And the counter thesis? What would prove us wrong?
Two specific data points would challenge our structural reset thesis. First, if BCA achieves operating break-even or better in Q3 2026, not just improvement, but actual positive operating income, that would signal the commercial business has crossed a genuine inflection point, not just a gradual improvement trajectory. Second, if the Boeing 737 production rate reaches 47 per month without a labor disruption and without triggering new supply chain charges, that would demonstrate that the operational infrastructure can support the rate increase. Those two events together would meaningfully weaken the structural reset framing.
And the thesis check?
The full weight of evidence from this filing confirms the structural reset classification. Revenue is growing, the backlog is enormous, and operating cash flow is moving in the right direction. But BCA is still losing nearly $1 billion in 6 months. BDS just took a $280 million charge on a flagship defense program. BGS margins are compressing. Net income is negative $448 million. Cash fell $2.2 billion in a single quarter. And the operating income improvement that headlines this filing is substantially explained by the absence of a prior year DOJ penalty. From a valuation framing standpoint, this equity is priced for a recovery that the income statement has not yet delivered. The backlog is real, the demand is real, but the execution gap between Boeing's order book and its financial results remains wide. This is a high-wire execution scenario with limited margin for error, and the October labor deadline is the next test of whether management can keep the balance.
Mike, that is a thorough and grounded read of a genuinely complex filing. Thank you for walking us through it.
Always. And for listeners, everything we discussed today is sourced directly from Boeing's 10Q filing for the second quarter of 2026, filed July 28th. We have not speculated beyond what management disclosed.
A reminder that nothing on Aviation Intelligence Weekly constitutes investment advice. We are analysts of public filings, not financial advisors. Do your own due diligence. I'm Sarah Chen, he's Mike Torres, and we'll see you next week.